Hello and welcome to the latest Insider interview. Our guest today is Ben Whitmore, manager of the Brickwood UK Value and Brickwood Global Value Funds. Ben, thank you very much for coming to the studio.
Sam, thank you very much indeed for having me.
In the Global Fund, UK shares are the largest country allocation. Why is this?
So I think it comes back to starting valuations. For us, that's very important. And really, ever since 2016 and the vote to leave the European Union, the valuations applied to UK assets have got a lot cheaper. Now, I think there are other factors at work as well, maybe, but the key thing is that UK listed shares look lowly valued. They are objectively lowly valued, and therefore that's a good hunting ground.
Which UK shares are you really excited about at the moment?
Yeah, I think that there's a range of shares that are out of favour in the UK. That might be something like a Travis Perkins. That's a building materials merchant that hasn't been run particularly well in the past. It's changed its management. Those shares at the start of this year were available at below tangible book value. So there the stock market is being very, very cautious on the prospects there. So I think that's partly due to the fact it hasn't been run that well in the past, but also there's quite a lot of concerns about the UK economy. So that also leads to low valuations when people are worried about things. So a culmination of stock-specific worries and general macroeconomic worries, I think gives you the opportunity to buy some very attractively valued assets.
We've seen lots of takeover attempts of UK businesses recently. Is this a good or a bad thing for you as a UK equity manager?
Yeah, so I think there's clearly a temptation in the short run to think that it's a good thing because, let's say, the share that you had that was worth 100 is then valued at 130 the next day. But I think on a medium longer term, you might be selling out too cheaply when you think about the compounding effect over time of equity returns. And secondly, for a vibrant capital market, you need to have new companies replacing companies taken out so that there's a wide range of companies across a wide range of sectors, and so that it's not shrinking. And so I think any takeover, whilst in the short run might be appealing, there is a risk in the medium term that it's not as good as you think it is.
Some sectors that have done really well in the UK are banks, are defence. Are they now overbought? Has the run-up been too strong for these types of sectors?
So I think, so we take both those in turn. So banks, the leading banks in the UK, the NatWest, the Lloyds, are valued at sort of about 1.5 times tangible book value. I think there's now a fair valuation applied to those. They don't look as though there's huge amounts of tension on the valuation. Now they might still provide an attractive return from here, given the returns on equity, which are in the sort of high teens. But there does seem to be a much fairer valuation applied to them now, so there doesn't look like there's huge amounts of tension to look for there. In the defence stocks, so we hold their Babcock, which is a UK defence supplier. It's got a very strong position in submarines. Those shares have performed very well in anticipation of higher spending by the UK and Europe. And I think it's a harder judgment there, but any share that has a very high valuation attached to it in anticipation of strong profit growth in the future, for us that means the upside and the downside is much more symmetrical. And what we're looking for are investments where there's a greater asymmetry, so where we think the downside is limited and there's plenty of upside. So I think now in defence it's much more symmetrical. They're on high valuations, and I think it's unlikely to be an area where we'd look now.
The UK fund yields nearly 5%, which is ahead of the benchmark index. So does yield indicate good value to you?
Yeah, for us it's like a secondary indicator. It's a sort of byproduct. We concentrate on shares that look lowly valued on their profits and backed up by cash. So for us, that's more an output based off the ones that we found. You tend to find lowly valued shares tend to either have a high yield because the stock market is skeptical about the profit growth of the business, or if they've got a bit more stress, they tend to have no yield. So for example, we talked earlier about NatWest. NatWest is paying a big dividend now, but actually a few years ago it actually had no yield. So there are sort of two characteristics, and what we tend to look at is what is the value of the firm. We don't look first at the yield, that's a byproduct, but value investing as we do it tends to attract at the portfolio higher than average yield because lowly valued shares either have like a high yield or no yield in some cases.
Are there any companies with high yields that you think could also be strong capital growers?
Yes, you very much want to believe that any company you're investing in can grow its profits over the medium term, both its sales and profits, and therefore that will turn into sort of an ability to grow dividends. Now, there might be some cases where you think the yield is too high and you're expecting a cut, but we would always invest on the basis that we think the business can grow fundamentally its sales and profits over time, yes.
Which sectors in the UK and around the world do you think are overvalued and undervalued right now?
So I think one area that is quite lowly valued, consumer-facing shares are quite lowly valued at the moment. So if I give you an example from the Global Value Fund, we have an investment in a company called Mohawk. Now, Mohawk is the world #1 in flooring. So this is tiles, laminate, rugs, carpets, whatever you like on the floor for both residential and a bit in commercial. Now, because of high interest rates and difficulties in housing markets around the Western world, those shares have done pretty poorly as consumers have deferred expenditure. And so areas in that area tend to be quite lowly valued at the moment. That looks particularly lowly valued. So we've got a holding in that. Those shares we think are in a cyclical downturn, but at some point consumers will spend more on, if you like, flooring, which is all related to housing transactions and housing markets across, the US and Europe.
In the UK, two consumer shares that have been suffering recently are Diageo and Unilever. Typically, they've been quite expensive. Are they looking cheaper to you now?
As I said earlier, we have a screening process based off the Cape yield. This is the average earnings of a company divided into its share price, and then we express that as a yield. And on that measure, for the first time in a while, Diageo is showing as attractive. So that on our screens is now showing up as attractive. Unilever not quite so attractive, but definitely for the first time in a while, Diageo is, yes.
How do you know when to sell a share that's performed well for you, and how do you know when to buy more of a share that isn't doing so well?
Value investing is about having patience and waiting for the valuation applied to the security you've purchased to become more fairly valued. And that valuation change is what drives the performance. Now, in successful incidences, your security goes from 70 to 120, and then you reinvest those proceeds in other shares which are materially lowly valued. So there's like a competition for capital, and you're redeploying that capital into new lowly valued securities. Now, over the very long run, we've got 60% right and 40% wrong. There's always an issue faced with securities where they haven't done as well as you've expected. And the key for us is not to ignore those securities, but with a fresh pair of eyes, look at it and either buy more or accept that actually you made a mistake in that one and sell it and move on.
And can you give some examples of companies that you sold after a period of strong performance and bought more after a period of underperformance?
So when we're talking about the Brickwood UK Value Fund, we only launched that in February of this year, so there's not that long a time period to sort of really think about. But we have taken money out of Babcock, the UK defence company, which is highly valued now. And we have bought more of, I mentioned earlier, Hammerson. We've also bought some more of WPP advertising company, where the shares are very lowly valued because of fears over the economy and also some fears over AI and what might happen there.
Artificial intelligence is one of the big investing themes at the moment. For you as a value investor, does it look like a bubble?
So you probably won't be surprised, as I'm not sure. If you look back in the late 90s with the internet, people got very excited there. But actually, probably the change was more profound than people actually realised at the time on how businesses have changed and industries have been structured. I'm sure there will be a lot of change that AI causes in the same way when electricity came along or various other sort of key things in industrialisation. But we're also very aware of what we do try and do and what we don't try and do, so we don't try and predict trends that may or may not happen in 5, 10, 15 years' time. We're very focused on the individual companies and looking at the why it's lowly valued, what are the issues, what are the risks, and trying to form a judgment there. And at the same time, trying to make sure that the asymmetry when we invest in it is very attractive, so that if we're wrong in our thesis, the downside's not that much, and if we're right, we make a significant amount of money. We're not trying to understand all parts of the economy. It's too difficult. We focus and concentrate on individual companies.
And finally, the question we ask all of our guests: do you personally invest in your funds?
Yes, so I'm personally invested in both of those funds, and without a shadow of a doubt, that is my most material equity exposure.
Ben, thanks for coming into the studio.
Thanks very much indeed.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.